All right, let's talk about the big story, which is what global financial markets are dealing with, even as fears increase of an imminent attack by Russia on Ukraine. The latest we're seeing on Wall Street, the Dow Jones down about 1% now, 358 points. The Nasdaq down very mildly, flat to negative actually, I would say just about 17 points, while we're seeing the S&P 500 down about 30 odd points. We'll show you those live rates in just a bit. But the big story today is really what happened in the Wall Street. 1,700 points down on the Sensex, 500 points and more on the Nifty, a complete sea of red. Now, was this entire fear of the Russian invasion in Ukraine, which could trigger a meltdown of crude prices and then impact markets around the world, was that just an excuse of sorts for the kind of bloodbath we're seeing? Are there bigger signals that we're missing? To speak on some of this, I'm joined now by Ajay Bagga, Market Expert, and David Madden, Market Analyst, Equiti Capital. Welcome to both of you, and thank you so much for speaking with us on the show. Mr. Bagga, let me begin with your overview of what happened today. Is it just simply the fears of the Russian-Ukraine crisis and the U.S. stepping in, those tensions escalating?
Yeah, the markets are factoring in higher risk premia based on that second order effects will come in terms of disruption of energy supplies to the European economy. What will be the impact on the European economies if the conflict expands further, or if it gets into a direct confrontation of NATO versus the Russia? What happens then? Even though historically we have seen with the Georgia invasion in 2008, with the Crimean annexation in 2014, there was not much of an impact on the European GDP. And the markets also had very short-lived corrections, which they caught up fast. The Russian economy did suffer, the Russian market suffered, and normally the Russian stock market, which moves in line with the oil price, has diverged from the oil prices in the last couple of months, ever since they started this build-up. So that is there, but for the rest of the world to see these kind of corrections, I mean, the German markets were down 3.4% early this morning. That kind of disruption is really second-order effects and the worst-case scenario being baked in by the markets, Tamanna.
David, how do you see this situation unfolding? Because that same amount of panic is not really being seen on Wall Street. Yes, the markets are down in the red, but they seem to be dominated more with concerns of what the Fed will do next.
They do indeed, and it's a question of geography. If you're based over in the United States of America, even if a war does break out in Eastern Europe, from an economic and in turn a financial markets point of view, it's probably not going to have much of an impact on the operation of companies that are listed in the US. Where the major move we've seen here today is the German economy, is the German market, the DAX. The German economy is very dependent on natural gas coming from Russia, in many instances via Ukraine. So a conflict in that part of the world could cause major energy supply issues for Germany, the largest economy in the Eurozone, the largest economy in the EU, and by no means exaggeration, the real engine room of mainland Europe as a whole. So it's no surprise we're seeing declines in excess of 2% on the German stock market, also the French and the Italian. Think about the geographic location of those countries and how they're all interconnected. They're very much tied in what's going on the edge of the European Union between Russia and Ukraine. Meanwhile, although we did see declines earlier on the US index futures, you're right in saying that they're much more concerned about what the Federal Reserve are going to do. Traders are essentially pricing in at least several interest rate hikes from the Federal Reserve. Those who think the Fed are going to have a relatively moderate hawkish update this year, about 3 rate hikes. Some people are a bit more fearful for 4 or 5 rate hikes. And in that decision between a possibility of 3 rate hikes and 5 rate hikes, realistically speaking, this is the sort of band at which the US stock markets are wavering between. Which end are we looking at? Earlier today, we heard James Bullard reiterate his view. He expects to see interest rates lifted by 1% between now and July. Mr. Bullard speaks for himself, not the entire Fed. But that really just kind of goes to show that at least some central bankers in the US are at the more hawkish end of a pretty hawkish Fed to begin with.
Mr. Bagga, I also want to understand the way markets have been responding. I'm talking about Indian markets. David talks about geography, but by that extension of that theory, I don't see why Mumbai's Dalal Street has been so impacted by what is happening on the borders of Ukraine and Russia. But clearly, it's a bigger story than that. And that's what I want to ask you about, because these fears of escalation keep popping up every few days. And we've been seeing this over the last 3 to 4 weeks now. So what really is the reading? Are the United States statements and those coming from President Biden, which seem to suggest that an invasion is imminent, are those not being taken as seriously? Because on the other side, you also have the Ukrainians saying, don't cause panic. Is there a broader understanding that market experts have of the situation that we are not absolutely seeing?
No, today we had FIs selling more than 4,000 crores. So it was very heavy foreign institutional investors exiting some counters in the country. And it was the heavyweights as well as the small caps were down 4%. So we had pretty heavy selling, Tamanna. And most of it, I think, would be impact on us of Ukraine. We have some limited trade. We have 20,000 students studying in Ukraine, but the GDP impact is not there. With Russia, we have a very strong relationship, and especially the defense relationship is very strong. But again, the markets are not really fussed about that. It was more the oil price and what the Fed will do. I think those were the two big factors. Ukraine became an issue today in a geopolitical sense that global markets opened down and Indian markets also got caught in that. But overall, for India, the impact of Ukraine either ways is very limited, very superficial, and very transient. It won't really last much for us. And we are not dependent. Some sunflower oil and stuff like that. We are self-sufficient in grains and wheat. So not much of an impact. It was more the oil price rising and what happened at Wall Street on Friday. I think that was the carry forward into India, and the concentrated selling by foreign institutional investors, which has been there since October. We have been seeing this selling.
Yeah. So by that extension of that logic, Mr. Bagga, how long do you see this pain lasting? Because the point you made about FI selling has been going on for some time now. They've been dumping investments out of India. So a mixture of Ukraine, Fed fears, all of that has been looming. But do you see this pain going on for some time as far as Indian markets are concerned?
I think markets have front-loaded all the risk, even the geopolitical risk as well as the Fed risk. Goldman talks about 7 rate hikes. The Fed fund rates is showing 1.75 by the end of this year, which again points to 7 rate hikes, or maybe less of with one of 0.5. So markets are over dramatizing the rate hike. Mary Daly, the San Francisco Fed president, she has been very prescient in September, in November, and in December. She called the Fed pivots when they moved from transient to more lasting, to taking away accommodation, to accelerating taking away the accommodation. She called it very well. And yesterday she was on the CBC show in the US in the evening, and she talked about stabilization, calibrated actions, and making sure that financial stability is maintained as the accommodation is taken off. And she said, we have signaled that we are going to tighten. We will raise rates in March. After that, we will be very data-driven. I think she was very moderate, but Bullard came in today, this morning, and he gave the interview. And, guess what? So many of these Fed presidents have been caught in the past dealing in the markets themselves. So it becomes very frustrating to really see this happen. And then in the end, they say, of course, Powell will decide. Then why are you coming and shooting your mouth off? He did that on Friday. Then two other presidents spoke after him, trying to make sure the markets understood that it's more calibrated. And again, this morning, he was on business channels shooting his mouth off on the same thing. And if you read his interviews, in the end, it will say, oh, I'll leave it to Jim Powell to decide, and let's see. But the headlines in the media are that, and the Dow went down 300 points immediately.
I'm sure investors also looking at what is being said by all of these different voices and calibrating what will happen. The Dow Jones down 300 points right now, in fact, 326 points to be precise. David Madden, how long do you see the pain continuing as far as global markets are concerned, as far as US markets are concerned? Because both of these factors will continue in tandem over the next few weeks, whether it is uncertainty over what the Federal Reserve will do, or these fears of an escalation of tensions between Ukraine and Russia.
I think the uncertainty in the financial markets is going to carry on until at least early to mid March, and really kind of anchoring around when we have the update from the Federal Reserve. Now, it's looking quite likely that we are going to see some sort of an interest rate hike from the US Central Bank next month. But the question is, how large will the rate hike be? Will it be 0.25%? Will it be 0.5%? Will it be a quarter of 1% with quite a hawkish update to suggest we're going to be raising rates at the next meeting and the next meeting as well? I think that's really going to be the determining factor of the trajectory of financial markets for the next 2 weeks. Because for the time being, we're all expecting several rate hikes this year at the top end, up to 7 rate hikes this year, which I think would be quite aggressive, considering we've come from almost 0 rates for quite a prolonged period. But I think somewhere in the region, more like 4 to 5 interest rates is somewhere rational. And I think if the Federal Reserve were to play it a little safe, which I think they should, do 1 rate hike, 0.25% rise, and then give off the impression to say, we'll see how it goes in a few months' time. We don't want to go from going one extreme to the other, almost 0 rates for the guts of 2 years, to hiking by a quarter every single chance that you get. I think that itself could automatically gear down the recovery in the US economy, because although inflation is at 7.5%, a 40-year high, the unemployment rate at the most recent non-farm payroll report actually ticked up. And you don't be putting too much emphasis and focus on the employment of the inflation reading while ignoring the ever so slight increase in the jobless rate.